Hello and welcome to this webinar on Minerva Analytics 2025 Australia Proxy Season Review. Today I'm joined by our Stewardship Team Lead, Thomas Bolger.
Thanks, Alex, and welcome everyone. I'm looking forward to discussing the key findings of the reports and what's been happening in Australia in the most recent proxy season.
Excellent. Well, without further ado, we'll jump straight into things. Now, Thomas, the headline support for management in Australia stayed above 93% in 2025. Yet the briefing itself describes a market where accountability tools are being tested and adapted. Could you explain a little bit why this AGM season it's proving to be more important than the headline numbers suggest?
So, Alex, so it is true that headline shareholder support for management did remain high in 2025 in the selective Australia 200 index, which is the focus of the reports, and the 200 largest Australian companies, as support did stand at over 93% on average. And on the surface, that does make 2025 look like a relatively quiet season and broadly unchanged from last year's support level. But that headline figure is doing a lot of work, and in some ways, it does hide what's happening underneath and some interesting developments we have been seeing in the market. So one thing that did stand out in 2025 was how investors focused dissents and reserved opposition for governance flashpoints and areas where voting could be used to send a clear signal on issues like, say, board oversight, remuneration, or responsiveness to shareholders. So while headline support did remain high, that doesn't mean weak oversight from shareholders where accountability mattered.
Right, and I think carrying on from that, this season we saw only 12 management resolutions defeated. However, it did seem that dissent became more selective and strategic. Where we saw that dissent, it was more targeted. So what does that tell us about how institutional investors are now using their votes in Australia? Like, are investors becoming more deliberate about where dissent will land hardest?
So the absolute number of defeated management resolutions this year did increase slightly from 10 to 12, but the more important message here is where, as you say, dissent was concentrated. So investors didn't spread opposition broadly across the ballot. Instead, they focused on a narrow set of resolutions that offered the clearest accountability signal where concerns were held. So notably, in the 2025 season, the only defeated resolutions fell in just two categories, and that was board-related resolutions, namely director elections, and secondly, remuneration-related resolutions. Whereas last year, there was a greater spread of defeated resolutions spanning board, capital, remuneration, shareholder rights, and sustainability. So there has been a narrower focus this year in high-profile contentious votes. But in terms of the number of high dissent resolutions, that is resolutions that received 20% or more shareholder dissents, there was also a modest increase from last year, from 103 to 109, although still well below that 2023 peak we saw in dissent votes. So this does suggest that investors are not, say, disengaging or pulling back from expressing concerns where they do hold concerns with companies and boards, but they are choosing their moments carefully, whether material or persistent governance concerns and where boards are not sufficiently responding to these shareholder concerns.
Right. I mean, it's interesting to see that trend this year of shareholders becoming more targeted. I think it's very reflective of the state of the market, the uncertainty of the market we're in right now, and coming down to defeated resolutions, going off the back of this high dissent trend. High targeted dissent trend, I should say. All defeated management resolutions fell into just two categories this year in Australia: director elections and remuneration. So to what extent are these votes now doing a double duty as accountability tools for issues like strategy, capital allocation, and climate? Should boards still assume that a vote against pay is really about pay?
So there is a view that director and remuneration votes are doing double duty in Australia, as you say, and the 2025 season findings do appear to reinforce this view. So structurally, Australian shareholders have few effective levers So shareholder proposals face a 75% supermajority voting threshold to pass. Director elections happen on 3-year cycles, and there's a no vote on the annual report or a resolution to appoint the auditor. So against that backdrop, board and pay votes do become the practical outlets for a much wider set of concerns. So as I mentioned, in 2025, every defeated management proposal in this year fell into just those two categories. So that does tell us that investors are using them not just to assess a governance or pay design, but to express concerns about issues like strategy, capital allocation, climate oversight, or shareholder rights, where there's no direct agenda item on the ballot to express these concerns. So if we take a couple of the companies that faced a defeat on remuneration in 2025 and look at the reasons why they saw defeats. So James Hardie, they faced a defeat due to concerns over shareholder rights and the undertaking of significant M&A activity without seeking shareholder approval. NRW faced a remuneration defeat when they've now actually faced consecutive remuneration strikes for several years now, signaling ongoing concerns and a lack of board responsiveness to shareholder concerns. Next, DC, they faced concerns due to concerns with pay levels for the CEO. While Vault Minerals, they faced a defeat primarily due to concerns around the pay granted to an outgoing CEO. So we have a mix of shareholder rights, board responsiveness, pay practices, and succession planning concerns driving these key votes. And if we also look at some of the other high dissenting votes, say WiseTech Global, their remuneration strike was informed by concerns over a regulatory investigation into alleged share trading activity during restricted periods by insiders. So I think to answer that second part of the question more directly, boards should not automatically assume a vote against pay. It's always about pay. In many cases, it can substitute, a signal, a way of expressing dissatisfaction with, broader governance concerns or board decision making.
Right, and this is something that we've definitely covered in almost every year of Minerva's Australia proxy season reviews. It's an ongoing issue, as you mentioned, that 75% threshold for shareholder resolution. So these more traditional ways of holding boards accountable, it's good to see at least that some of those defeats are going through and sending signals, and the market's still operating well. But moving on to kind of zoom in a little on that James Hardie AGM. The briefing really does highlight that AGM with 3 directors voted down after the AZEK acquisition. So what does this case, if you could dive a little deeper into it, what does it tell us about how investors are approaching individual director accountability in Australia?
So James Hardie does appear to be, the standout governance case from this voting season. So to provide some background on the situation here and why there was such a big vote from shareholders. So in March 2025, James Hardie announced it had entered into a merger agreement with the AZEK company, a US listed company, whereby James Hardie would acquire the company for a combination of cash and shares for a total of 8.75 billion. And this would entail the issuance of shares amounting to, approximately 35% of its share capital. So the acquisition was transformational and would result in a dilution of existing shareholders. However, the Australian Stock Exchange, the ASX, did grant James Hardie a waiver from the requirement for a listed entity to obtain shareholder approval before exceeding the 15% placement capacity, with the waiver being related to the ASX shareholder approval and merger process under US law being considered to be sufficiently similar to an Australian scheme. So this did create an accountability gap and concerns that a dilution of shares to the extent proposed and the potential shift of James Hardie's primary listing to the US would have been made without being subject to shareholder approval. So whilst James Hardie did commit that it would not shift its primary listing without holding a shareholder vote, this didn't prevent shareholders from expressing concerns at the AGM, and investors actually did end up voting out 3 directors, rejecting remuneration reports, an LTIP grant, and also an increase to non-executive director fees. So this voting result does send a broader signal to the market and to the Australian Stock Exchange regarding investor expectations for shareholder oversight and consent in relation to transformational transactions. And in response to the backlash, the ASX actually announced a review of the listing rules relating to shareholder approval requirements and listing admission status. So I think this debate is also what we have been seeing in other markets, so around market competitiveness and, say, compliance burden with jurisdictions amending rules as a way to support business to list and also grow. So, for example, in the UK, the listing rules were amended the other year, to which also did weaken shareholder oversight mechanisms around approving transactions. So this general movement is provoking investor concern about governance protections and making the case as to why, say, effective corporate governance and also shareholder rights can help companies perform better by helping ensure they are well run, transparent, and accountable. Noting that, say, well-managed companies that make decisions in the best interest of shareholders are more likely to grow sustainably, avoid costly mistakes, and also attract long-term investment. So there is this kind of debates generally, which we're seeing across markets, which is again evidenced here in this James Hardie case.
Right, right. Yeah, it's certainly an interesting and, as you say, standout case for this season. It'll be interesting to see if the same types of cases occur in Australia next season. But if we zoom out now back out of that very specific case and talk more generally about remuneration strikes, this was one area where the number of remuneration strikes really did fall in 2025, but where they did occur, the dissent was much higher. So how should investors and boards interpret that shift? Does it suggest an escalation rather than a disengagement entirely?
So what we did see is that the number of remuneration strikes did actually fall this year from 26 to 20, but where strikes did occur, dissent was actually higher, so averaging close to 43% where a strike did occur. So this does indicate that, say, investors are not, say, backing away from pay scrutiny, but they're becoming more selective, which we've kind of mentioned earlier. So fewer companies have been targeted, but those that were did face very high opposition. So in other words, this does look more like, say, escalation than disengagement. So where boards are unresponsive or controversies persist, opposition is firmer from shareholders. So for boards, this can raise the stakes. So a strike is increasingly a sign of entrenched concern rather than, say, routine frustration, and can also signal, say, wider governance and shareholder concerns at a company, not just concerns with pay practices.
Right. I think now we should probably move on to the discussion of, say, on climate, which has previously, in previous years, received quite a lot of support in Australia. This year, in the 2025 Australia proxy season that we're covering, half of Say on Climate votes attracted over 20% dissent. Yet Australia is now moving into its new mandatory climate reporting aligned with IFRS S2. So does that change the future role of Say on Climate votes? How do we think things will change going forward?
Australia is one of the few markets where saying climate has now become a regular feature at AGMs, particularly in, say, high impact sectors such as mining and energy companies. So what we have seen in Australia is that saying climate votes does attract shareholder scrutiny. So 4 of the 8 votes in 2025 did receive 20% or more dissents, and average shareholder support in 2025 stood at 78%, which is well below the 93% total average for the year. And notably, Australia continues to be the only market in which a company has actually faced a say on climate defeat, which occurred at Woodside Energy in 2024. So whilst Woodside did not put forward a revised transition plan to a vote this year, shareholders did continue to express concerns over climate strategy and board responsiveness this year, with the chair of the Sustainability Committee, Anne Pickard, receiving around 20% shareholder dissent. And at the same time, Say on Climate and also Director Accountability for Climate does continue to be a key focus of shareholder proposals filed in Australia. So climate is continuing to be a key engagement theme for investors across different types of resolutions. But as you noted, climate reporting is shifting from voluntary to mandatory, with Australia adopting RS S2 aligned standards. So the function of saying climate votes may evolve in light of this. So it could be that investors may rely less on advisory climate votes and more on, say, director elections or other agenda items where there are concerns with disclosure and oversight. They won't necessarily need to wait for a 3-year cycle of saying climate due to the disclosure being provided by companies in the area. At the same time, as we've seen in other markets, some companies might make the case that as the climate reporting framework matures and becomes mandatory, whether, say, voluntary, say, on climate votes actually remain necessary, particularly in the absence of any legal requirement to hold such votes. So because of this, it will be interesting to see how, say, climate votes do develop in Australia, but importantly, these developments do reflect, say, the rising expectations that climate risk management should be embedded in board accountability, and now it's also embedded in regulated reporting. So there is the potential now for more consistent and comparable climate reporting from companies, which will enable investors to assess reporting and make informed stewardship decisions on a wide range of agenda items.
Excellent. Yeah, it's certainly a positive development, I feel, in the Australian market to see how the Say on Climate movement has taken off, and hopefully, well, my opinion is that the new IFRS S2 aligned reporting should only bolster the Say on Climate votes, but we shall see in time. But moving on now, back to shareholder proposal filings in general. You mentioned a little earlier in the webinar that Australia is a particular market where some other votes on other issues have to do double duty because shareholder proposal filings require a 75% threshold to pass. In 2025, we saw an increase in the number of proposals filed by shareholders in Australia, but none of those passed, largely due to that 75% threshold. So are shareholder proposals in general still a meaningful tool in this market? What does this season tell us about how they are useful as a tool? And is this why we are seeing greater use of litigation alongside voting?
The shareholder proposals do still remain a meaningful engagement tool, but their role in Australia is constrained by local market rules and practice. So there was a rebound in filings of shareholder proposals in 2025, which does highlight that investors are still willing to use filing shareholder proposals as an engagement tool, particularly on, say, requests for transparency on environmental practices we saw this year. However, the unique circumstances in Australia does impact the functioning of shareholder proposals. So a shareholder proposal is considered binding under company and management, and therefore is subject to a 75% supermajority voting threshold to pass. As a result of this, shareholders commonly file a proposal to amend the company's constitution to introduce the rights for shareholders to file advisory non-binding proposals. So at AGMs, you'll typically see, say, one proposal to amend the constitution filed as a special resolution and therefore subject to that 75% threshold, and then one or more advisory proposals that are, say, conditional on the constitution proposal being successful. But so if a constitution proposal is not successful, then the advisory proposal cannot be carried regardless of its level of support. And no constitution amendment proposal has passed in the market. So this does restrict the effectiveness of passing proposals in the Australian market. Although filing shareholder proposals do, as I said, continue to be, say, an important engagement tool to raise topics for discussion at a company and also, say, aggregating shareholder views on that issue. So in 2025, we did see that shareholder proposals were dominated by two key themes, which were climate change and, secondly, nature and biodiversity, with proposals seeking enhanced reporting in these areas, seeing some notable voting results, say, such as a proposal at Woolworths seeking enhanced reporting on its farm seafood practices impact on endangered species, and that received over 30% shareholder support. So despite these constraints, shareholder proposals aren't going away, but we do still remain below that, say, record 2021 year in terms of, say, the number of shareholder proposals filed and also the average level of support recorded on shareholder proposals. So we expect that, say, shareholders will continue to utilize, say, different methods for engagement depending on their stewardship strategy, the issue, and also the company context. So that could be filing a shareholder proposal, using other governance accountability mechanisms such as, say, director votes or remuneration report approvals, or the potential use of litigation. And earlier this year, there was a notable case with this investor kind of like litigation activity. So in February 2026, the Federal Court of Australia handed down its judgment on the Australasian Centre for Corporate Responsibility's claim against Santos Ltd in relation to alleged misleading or deceptive statements on climate change. Whilst the court dismissed the claims, this does highlight the importance of greenwashing risk for investors in companies when reporting on ESG and climate. Australian regulators have also highlighted greenwashing as a priority enforcement area as well. And also notably, the Australasian Centre for Corporate Responsibility is actually a prominent filer of shareholder proposals. So their, say, litigation action does highlight the varied tools used by shareholders and advocacy organisations in raising ESG concerns at companies.
Excellent. Well, I think to kind of bring us towards the tail end of today's webinar, we've discussed some really important trends and unique features of the Australian market when it comes to the AGM season, many of which you highlighted there, and the various tools being used by shareholders and by investors to make their voices heard at companies and shape the governance of companies in the quote unquote right direction. If you had to leave investors with one practical takeaway from the 2025 season, what should they do differently in their Australian voting and engagement strategies heading into the 2026 season later this year? Where do you expect the next pressure points to be?
So I think a key takeaway for investors and companies when looking at this season, they should be cautious about, say, interpreting the high average support as a sign of a quiet market. So the focus should be more instead be, say, on where shareholder dissent is being directed, what resolutions, what companies, and why it is occurring. So heading into 2026, I think there's several key areas to watch closely. So this will include how the ASX develops and oversees the corporate governance principles following recent changes to its supervision of the framework, as well as the ongoing debates around shareholder rights and governance accountability, particularly in light of that James Hardie case and the subsequent listing rule consultation we discussed. And then that introduction of climate reporting on a mandatory basis is another key development, with saying climate votes continuing to attract investor scrutiny as expectations around disclosure and board oversight increases. And then we're also seeing, say, more director accountability voting on climate, and shareholder proposals will likely continue to be filed in that area. So climate will be a key item to watch to see how that kind of mandatory climate reporting develops and impacts engagement. So from a voting perspective, director elections and remuneration votes are expected to continue to remain the primary escalation tools, especially where shareholders are dissatisfied with, say, board oversight, responsiveness to shareholders, or decision-making and risk oversight. So for 2026, it will be important to continue scrutinizing the patterns and dissent of and why they actually are occurring, rather than to say the headline outcomes alone, and to pay close attention to why particularly, say, directors or pay outcomes are attracting opposition.
Brilliant. Well, thank you, Tom, for sharing your insights today. And thanks to everyone who joined us for this session. If you've not yet downloaded Minerva's 2025 Australia Proxy Season Review, we encourage you to do so today. So for the full data analysis and context behind the themes we discussed, that's all contained in the full briefing. We'll also send you each a copy of the briefing directly to your inbox if you attended this webinar. So we'll make sure you have it to hand. Before we close, a quick reminder as well to keep an eye out for our next briefing, which will provide an overview of Minerva's horizon scanning survey results. This is a survey we put to our clients and to the wider public, asking them what their main stewardship concerns are for the foreseeable future. And it provides a good setting through which to talk about some of the major issues we're seeing currently unfold in the 2026 peak proxy season. So thank you again for joining us, everyone, and we look forward to seeing you next time. And thank you, Tom.
Thanks, Alex, and thanks everyone for joining us today.